Hello, everybody, and welcome to tonight's workshop on Social Security. We're going to get started here in just a few minutes. I'm just getting some final touches on the workshop, and let me mute my speaker. You're hearing me talk twice. All right, so we're going to get started here in a few minutes, and like I say, I'm just working on a couple of things on my side. I know that people can join 15 minutes early. I see we already have a couple people online, but we will get started here in about 15 minutes or so. Feel free to just get ready, or you can send me some questions in advance. If you are on some of the sites, YouTube, you can put those in the comments. If you're on Facebook, you can put those in the comments as well. And if you are joining us on LinkedIn and or um, Zoom, you'll be able to ask me directly through the channel. So anyhow, we will get started here in just a few minutes. I'm excited to get started. A lot of changes here in 2025, and there are a couple of hacks and tricks that we will share with you along the way. Talk to you in a bit. Hello, everybody. We will get started here in just a few minutes. For those of you, I see we got a number of people who have jumped on the call. We will get started. Again, we will go about 1 minute after the hour, which is in about 9 minutes or so. And appreciate you tagging along. If you do have questions, you can feel free to go ahead and put those in any of the comments wherever you're decided to watch us, whether it's LinkedIn, YouTube, Zoom. You can go ahead and pre-populate questions if you have any. We'll take a couple of questions towards the end. This workshop is about, I'd say 45 minutes to an hour long, depending on questions. And again, we will jump into that in about 8, 9 minutes. Thank you for joining. All right, hello again, everybody. We will get started here in just a few minutes, just putting on some last minute touches to the workshop seminar. It is 2025, so we have made a couple of changes to this, and we will jump in here in just a few minutes. Thanks for joining. Hello, everybody. Again, Terry Martine here. As we get people that added to the call, I see that everybody's kind of joined in various spots. If you do have questions, though, do me a favor. We've got LinkedIn, Facebook, YouTube, Zoom. We got all these different platforms these days. Just do me a favor, go ahead and add questions as you go, because at the end, what I'll do is I'll scan through there and I'll answer questions towards the end. Okay, so if you do have questions, pop them in and I'll circle back towards the end and go ahead and try to get as many of those answered as I can. Again, thanks for joining, and we will get started here right at the top of the hour in about 4 or 5 minutes. All right. Hello, everybody. Terry Martine here. We are going to get started here in just a few minutes, but I like to answer a couple of questions that I got through email, just as kind of a warm up, and we'll start this pretty much at the top of the hour. But one of the things with Social Security that we see is that a lot of people just assume that it's an easy thing, that you really don't have to do any preparation to it. That's kind of not true, because you really want to maximize it. So if you're on this call, and again, we'll get started here in just a minute, but I'm going to show you a couple different ways that you can maximize it. And it could potentially be 20, 30% more. So it's super important because you're going to get it via, lifetime. And it's one of the very few benefits that you're going to get, that you're going to carry throughout your lifetime, that does not go down. Social Security has never gone down as far as the payments go. Everybody's worried about some of the things that are going to happen. There's obviously 3 million more people now that are going to get increased Social Security. And if you've ever been to any of my other workshops on Social Security, you know that we talk about how they make changes to this, not in your benefit. They're always adding more people to it, or and it really decreases the amount in the pool, and the pool obviously runs out of money at some point. So we're going to cover all these things, but be sure and put your questions in. The questions are, I've done this presentation hundreds of times, but you may, if this is your first time, have only seen me do this once. And I want it tailored to the individuals who are on this call as much as I can, right? There's some general information here that I'm going to cover, but by and large, I want to make sure that it's tailored towards you. And the only way I can do that is for you to ask me questions. All right, so I'm going to do a brief little pause here, and I see we have a bunch of people that just joined in. The folks that I can see right now are on the Zoom call. We've got quite a few on Zoom tonight. And if you're on one of the other platforms, we'll be sure and get to your questions towards the end. I'll cycle back and go ahead and answer the questions. All right, so give me 1 second here and we'll get fired up. All right, welcome, welcome, welcome. It is 2025, and we are here talking about Social Security, how to maximize it, and we'll get started right now. One of the big issues with Social Security is that Again, I just talked about this a little bit, but people look at it as though it's a benefit, but they don't spend much time putting it into practice, and really discovering about how much they could get, whether it's delaying or whether it's coordinating a benefit. So we want to make sure that you're going to get this. Remember, this is one of the few benefits in life that you are going to get for the rest of your life. All right. It's worth it to spend a couple hours and figure out how to maximize it, because it could equal another 10, 15, 20. I've seen it as high as 30% by coordinating benefits. All right. So again, my name is Terry Martin. And if you join this because you want to maximize your Social Security and or lower your taxes a bit, you're in the right place. We're going to talk about that tonight. And first things first, the disclosures. I am a fiduciary, so I have to put my clients first. Second of all, I am not an attorney. We will talk a little bit about that tonight. And we will talk a little bit about, well, a lot about Social Security, and I'm not with Social Security Administration. But we're going to talk all about that. And again, when we talk about investments a little bit, we're past results are no guarantee of future performance. All right. So now that we got all these basics out of the way, there's two ways that you can maximize what you get out of this workshop tonight. The first option is for you to download our workbook. We have a workbook that you can download for those of you who are do-it-yourselfers, and you can go in there and write out all the questions and answers, and it will help guide you figure out how to maximize your benefit. Option number two is to have my staff and I prepare the report for you. And really, we're going to do all the heavy lifting. It takes about 5-10 minutes for us to get the information. But as you'll see, we've got some enhanced benefits that will help you decide when and how to take Social Security. And being a part of that, the reason why this also talks a little bit about lowering your taxes is we can't really talk about maximizing your Social Security benefit with also talking about minimizing your taxes. All right. For every dollar that we save you in taxes, that's another dollar you can spend on your trip to Europe, food, whatever your case is. We try to coordinate that because they really go hand in hand. You can't have one without the other. All right, so why is Social Security such a hot topic? It's a hot topic every election cycle. It's a hot topic every year. They do their cost of living increases. It's really such a hot topic because every day there are 12,000 people added to 12,000. That's quite a bit. Turning 65 and starting to take Social Security. And that's about 3.5 million people per year. Now, I didn't add the slide in here, add the line, but for those of you who follow Social Security or read about it in the news, you'll know that they just made those government workers, and I'm not sure exactly which government workers it was. I'm still getting clarification on that, and I don't want to misspeak on this workshop, but certain government workers now, if you had a government pension offset, or one of these that you lowered your Social Security, there were 3 million people that now are going to get an increase in Social Security. That's both good and bad. It's good if you are one of those people getting Social Security benefits that were cut or reduced, but it's not good for the rest of the folks. For obvious reasons, there's 3 million more people now drawing from the system. All right. So what does Social Security mean to you? The slides up here, the reason why I put this up here is that the Social Security is really a safety net. I think of it as a safety blanket. It's one of the few that you're going to get, again, that your whatever amount that you're going to get from Social Security, it starts at one value. It goes up with the cost of living increases that the government announces. And the good thing is it never goes down. That's the good thing. Whatever your benefit is, it'll continue for as long as you're taking your own benefit, it'll continue for the rest of your life, and it'll only go up. So it helps most retirees, especially retirees that are needing that. You know, there's a lot of retirees that are getting $5,000-$6,000 a month when they retire. Most of that really comes from Social Security. The rest of it comes from savings or pensions or so forth. So it's real important that we get this right. And I'm glad you're on the call because you're one of the few that are taking the time to put in here just for your own benefit. I'll get into some of the reasons why it's better for you to do it on your own, so that you can make sure you're getting the most out of it, but and educate yourself on how it works. So 1985, 85,000, roughly 85,000 pensions have been eliminated because corporations have eliminated their pension plans. So for those of you that worked at AT&T, when I first got out of college, I started working for AT&T. You really think you're going to be working there for life. Everybody had pensions. It's a good thing. Now they've really scaled this back to where you really need to be working for a government agency. There's very few pensions left. And in addition to that, that pension now is really being converted to 401k plans. What this slide doesn't show you is that predominantly those 84,000 pensions are now 84,000 401k plans, which doesn't put the burden on the company. It puts the burden on you. All right. So that's really where the market is going. This is really why it's been important for people to put money aside for their retirement. All right, so a couple of questions to ask yourself. And do you insure your home? Obviously you do. Your car, health insurance, but to insure your retirement, it really comes down to Social Security, because again, it's going to be a basic benefit. It's not a lot of money. I mean, it is some money, but you can count on that for the rest of your life. So we always put that in the financial plans. All right, so how long we live. This is the oldest living person as of last month. I didn't check it this month, but she is 116 years old. So that's quite a few years. The point of this is to say that we don't really know how long we're going to live, but we really want to maximize that Social Security benefit, because that, if you live this long, you are going to more than benefit by waiting or coordinating your benefit so that you get the most out of it as possible. All right, what's our focus today? Our focus is two things. One is really the ground rules for benefits, and of that, there's a subset. We're going to talk about married couples, divorced couples, and widowers. There's a certain way that you can get money out based on those three. And of course, the follow-up, or the second part, is taxes. How to make sure that you are paying as little as possible in your taxes. All right, so what are some of the basics? I'm going to cover this fairly quickly. All right, I guess I should have also said, I am recording this. So for those of you who like to go back and either take notes or look at things again, I am recording this on YouTube. And in about 12 hours or so, once YouTube gets this uploaded, you will have the ability to go in and view this again. So for those of you who want to watch a certain section that pertains to you, maybe you will have the capability of doing that. All right. So basics of Social Security again. How do you qualify? It's pretty straightforward. Qualification is really just a matter of time. First off, you have to work for and the income you're getting must be covered, or Social Security must be being paid out of your paycheck. You need to work for 10 years and earn 40 credits, which means that you are earning credits every quarter that you work. And there is a minimum amount that you have to earn for that quarter to work. All right. So you have to earn $1,510 in order for you to earn a credit. So for most people, this is pretty straightforward. And you can earn up to 4 credits per year. All right. And so once you do that, once you say, okay, well, I've worked enough, I've got my 10 years of work, continuous work. What they'll do is they'll say, okay, Social Security is going to look at your work history, and it's going to take the highest 35 years index for inflation. All right, it doesn't take the average of the highest 35, but it is going to average or index it for inflation. For instance, if you made, say, $20,000 in 1980, It's roughly a fourfold increase. Again, it's approximate, but it is equal to about $80,000. So it's going to take a look at that 35 years. If you've got lower years, higher years, it's going to base it all on index for inflation, average those years, and that 35-year average is what is going to be calculated or used to calculate your Social Security benefit. All right. So there are exclusions or reductions to benefit. However, they've just done away with these. So even though they are on here, it is not accurate as of today because they have made some changes. All right. So how does Social Security work? Oh, I might want to add, some local state governments have opted out of paying into the Social Security system. They were not added back in. All right. We have a junior college down here that the employees have not participated in Social Security, so they are excluded. Even though they just did away with this pension offset and things, they are still opted out of Social Security because they never paid into it. All right, so how does Social Security work? 6.2% of what you earn every month, week, day, however you get paid, goes into Social Security, right? 6.2%. For every $100 that you earn, $6.20 is going to the basically Social Security Administration. Now there is a cap. So once you earn $176,000 this year, 2025, it will cap. You no longer have to pay into Social Security. Now the employer is going to match your 6.2%. So your employer is going to also pay in 6.2%. So for every $100, again, what really is going into Social Security is $12.40. And today's contributions, this is important because this is why Social Security is in trouble. Today's contributions, the contribution that you are making if you're still working, or your neighbors are making if you are looking to take Social Security soon, it's basically pay as you go. In other words, everybody is paying into the system. That money doesn't accumulate for you like a bank account or a stock account or any other account. That money gets pulled and goes right out the back door, right? So the money comes in, it gets cycled and goes right out to your neighbors who are collecting Social Security, which you will be one of soon. That's the whole reason why you're watching this workshop. All right, so what about solvency? Since 2010, it's been in the red. It's been in the red now for a while, and it's ever increasingly going in the red because there are more and more people drawing out of the system that are putting in. We could go into the mathematics of that, but in past workshops, people ask me not to get into that. But it is important to know that more and more people are taking out. There are approximately 70 million people out of the 360 million people living here in the United States taking out of Social Security. So that's a lot. That's quite a few people. It is fully funded through 2035. I'm willing to bet that that number drops to 2032 when they come out with the new update, which will be next year and about, comes out, I think it came out this year in November-ish. So they've got 9 months to really update this, and it is not going to look good. It's not going to look good on two fronts. One is it assumes the best case scenario in the markets. Two, it also assumes that this wave of people weren't going to start getting Social Security as well. So this number has been dropping for years. It used to be much higher, but it's going down. And then 2036, it is only funded to give you and me and everybody else that's in Social Security 83 cents on the dollar. So if you're getting $1,000 a month, if they only pay you what's in the system, your Social Security would drop to $830. Now, that's not going to happen, probably. For one, you and I are, if you're a voter, hopefully you are, politicians make these rules. Politicians can also get voted out. So any politician that really does too much to Social Security will be a short-term politician for sure. So There's 4 basic proposals to improve the solvency. They're probably going to do a combination of a few of these. They've already talked about a few of these. Nothing is, I think, finite yet, but certainly this are some of the things they're looking at. Increase the minimum wage or minimum age. You and I could, in theory, at 62, start Social Security. You start Social Security at loss. You don't get paid your full benefit. And we'll talk a little bit about the nuances of how you navigate the Social Security questions or issues. But suffice it to say, minimum age is 62, and you can start it, but at about a 25 to 35% decrease in the amount if you wait, right? So they're looking to increase that to 64, 65. They could increase the full retirement age. Right now it is 67. By and large, for most of the folks that are on this workshop, you did sign up. It's about 67. They could say, okay, the 30-year-olds and below, it's going to be 68, 69. They could increase the payroll tax. Again, you're paying 6.2%. Your employer's paying 6.2%. Maybe that goes up to 7, 8, 9%, whatever it is to increase or make sure that it doesn't go insolvent. They're going to have to do something. And oh, by the way, I always think it's interesting, but Social Security was never designed to really help people alive. Just so you know, it was really designed when it first came out. The average life expectancy of people getting Social Security was about 65. Now, they started getting benefits at age 65, but 50% of the population was no longer population. So it was only to help those people kind of as a long-term healthcare plan, because at 65, half of everybody had already passed away. So one thing they could have done back when they first came out with it, it was to increase it based on average life expectancy. That would have been one way to help, eliminate these issues. Now, anyhow, they didn't do it, but now they're all scrambling to figure out a way to do it. All right, and obviously they could reduce benefits. I think this is probably the least likely way that they could do it, is to decrease people's benefits. I just don't see it happening. So you can pull this up on the website. If you type in Social Security benefits based on your age, if you're born after 1943 to 1954, this is the chart for you. Most people, it's probably going to be 54 and after. So it's slightly different, but I like this chart because it's easy for me to explain the math. Just so you know, if you took it again at age 62, you're getting 75% of your allocated benefit. And the allocated benefit on this chart is age 66, where you get 100%. And if you wait, it's 132%. So this one's simple because it's 8% per year that you're going to increase every year that you wait. It's not quite every year, it's every month you wait, it'll actually increase slightly. But just keep in mind, the longer you wait, the higher your benefit will be. And do yourself a favor and either get the workbook, which everybody here is going to get, or if you want us to do the heavy lifting again for you, we just talk to you for a couple minutes, get your information, and I'll show you some of the reports that you get from us as part of this workshop. All right, so some of the Social Security benefits, there are 3. One is retired worker benefit. That's the benefit that you've earned for yourself. You're not claiming anybody else's benefit, you're just claiming your own benefit. Spousal benefit, it means that you're claiming a spouse. There are rules for this and we'll get into it, but spousal benefit means that you are trying to take roughly 50% of your spouse's benefit. I will say this, that the spouse has to start their benefit, and then the primary spouse has to start their benefit before you can get spousal benefits. Again, I'm going to get into the rules with this, but this is where it gets a little granular, and this is where you might have some questions. Right? Again, post questions in the Q&A if you are following along on Zoom. And thirdly is the widow or widow benefits. And that's where you're going to get benefits from your spouse. However, you are the surviving spouse, and there's some rules with that as well. All right, so some of your filing options. Now, I've only seen this happen to one of my clients out of all the hundreds of people that I've helped get Social Security, help maximize. And what happened was he filed for Social Security. You're allowed a 1-year do-over. All right. So within the first year, you have to pay back whatever they've paid you, but you get to reset your benefit, and you have to pay it back, but it's as though you never took it. So in the event you wanted to do this, there's only been one reason why somebody has done this or tried to do it. They didn't even accomplish what they wanted to, but only one reason being he had filed and his mother had passed away and left him a sizable inheritance. And he wanted to go ahead and suspend his benefit. It was during COVID lockdown. He could not get anybody to help him. If you ever had to call Social Security during COVID lockdowns, it was virtually impossible. But anyhow, he tried and wasn't able to do it. So he just decided to go ahead and keep his benefit. And he had enough money where he didn't care. But you could, in theory, pay it back, reset your benefit from 365 days from filing. Again, only one out of hundreds have ever tried it. All right, so some of the considerations for married couples. So if you are married, there is a way to maximize your benefit, okay? So this is important if you're married. Remember, if you're married, follow along. And again, if you got questions on this section, pop them in. To qualify, you have to be married for at least 1 year, all right? You can't get married and then 3 months later try to get spousal benefits. You have to be married for at least 1 year. The primary worker has to have filed, all right? So in this case, this illustration, you got Jim and Jane. Jane here is going to be filing on Jim's benefit. Jane can't file until Jim files, all right? So this is one of the gotchas on this. So it's tough because if Jim wants to wait to age 70, Jane misses out on 50% of her benefits until he files. This is why I say there's a couple of nuances to Social Security. This is one of them. Getting this right is a little bit tricky if you're doing it on your own. There is software. Again, we can do it, but if you want to talk to somebody, make sure your financial advisor knows about this and can get this squared away for you. All right. And again, it is 50% of your spouse's benefit. There's also a catch. Assuming that they have filed, let's say he did wait to age 70. All right. I got a chart that's going to show you this. Let's suppose Jim here waited to age 70. Okay. He has received 132%, which is great. However, Jane only gets 100% of his benefit, which is half. And this is where it goes a little weird, so just follow along. This is where she gets half of his benefit, all right? So let's say that his benefit, just for ease of this, because I want to illustrate it real quick, he is getting $1,000 a month at age 66. He decides to wait. He's like, well, I can wait and I can get 1,320 by waiting a couple of years. That's all great, except Jane could not file, A, because the primary has not filed yet. B, she does not get an increase in benefit. So if this was $1,000 a month, she gets $500 a month, $500 a month, $500 a month. You see how it goes? So even though he waited, and you hear this, and a lot of blogs and a lot of people get this wrong, you don't get 50% of 1,320. You only get 50% of his allocated 100% benefit. So that, if you got questions, feel free to shoot me an email or get a hold of me, because I know that part gets a little confusing for some folks, but you do not get an increase if you are a spouse. Your spouse would get an increase, but you would not. All right, so that's important to note. So at the survivor's benefits, at the death of the first spouse, the surviving spouse can receive a maximum of their own benefit. For instance, if your benefit was higher and your spouse died, you wouldn't want to get your spouse's benefit. That wouldn't help you. You want to get your own benefit. If the spouse's benefit is higher, then you want to get the spouse's benefit. This is if you survive your spouse. And if the deceased spouse filed early, you're going to take a decrease. All right. So you're going to get paid 82.5%. Again, there's some nuances here that really nobody likes getting decreased benefits, but these are the rules of Social Security. All right, so some of the common mistakes we see is that nobody claims. You just wait until both parties, hit age 70. That doesn't really benefit you. There's a way to coordinate those benefits so that you get. And then, or both people file early. And I just crossed these two up, but either both people file early, that doesn't help you. Because think of this, if you've got a primary earner that has earned a lot more than the spouse, you really want their benefit to go higher. And if it happens to be a male, then their life expectancy is less. So then the surviving spouse, typically female, although this, I'm just giving you basics, would get the higher benefit. So you really want to protect your family by one of you getting and letting it ride a little bit to get the increased benefit. Some of the considerations for divorce folks. Now, if you're divorced, you need to be married for a total of 10 years. Now, you may be divorced from more than one person. You may have been married for 10 years or more to two different people and be divorced from both. You cannot currently be married, or this could be three people or four. You could be married as long as it's 10 years or more, you can get the highest benefit. But you cannot be currently married. And the same benefit amounts and reductions apply for claiming early as they do for regular spousal benefits. Remember, I talked a little bit about that on the sheet. And independently entitled, meaning you have to be divorced for 2+ years. So they do make a carve out for this, but you can't get married for 10 years, be married, and then all of a sudden get divorced and then claim divorce spousal benefits right away. They don't allow it. You need to be divorced for 2 or more years. And some of the questions we hear for divorce, and really all this boils down to, is if you've got a nasty divorce, you don't want your ex-spouse knowing your business, basically. One of the reasons why you got divorced. So they don't. And so you call Social Security, you say, hey, I was married to Mrs. Smith, Mr. Smith. I am looking at getting divorce benefits. You do run into a few issues with this. One primarily is that due to HIPAA laws and some of the other laws, you are not allowed to give out information on a spouse. They can give you your benefit, but they can't give you spousal benefits. So it gets in a little bit of a tug of war. Hopefully you run into somebody at Social Security Administration that is going to help you. But I have had people say that Social Security won't tell them what the benefit's going to be. And it really makes it virtually impossible for us to figure out how to do your benefit. How are we going to figure out how to coordinate a benefit when we don't know the benefit? So hopefully you can get them to answer the questions for you. And some of the questions for the widows and widowers, a couple of qualifications is obviously you need to be a widow or widower. You have to be 60 years old. So one of the issues here, or not issue really, one of the benefits to you is that you don't need to be 62 years old to qualify for this benefit. You only need to be 60. So if your spouse has passed, you do only need to hit age 60 before you start collecting widow benefits or widower benefits. Now you have to be unmarried until age 60. This is one of the rules that commonly gets overlooked, but you have to be unmarried until 60. At age 60, and one day, you can go out and get remarried. Doesn't matter. But you have to. This is one of their hard rules. They do not bend this rule. I don't know anybody that they've ever bet the rule on. 60 years old, you cannot be remarried. All right. And you have to be married for a minimum of 9 months prior to death. So if you married and let's say one of you goes to off overseas, gets killed in action, say you're in the military, they do make exceptions for that. What they're trying to do is stop people from gaming the system. Get married, somebody's got cancer, terminal cancer, you get married, boom. You get, the widow or widower benefits. They are going to be very skeptical of that, and you'll have to prove this. The special exemptions are really for military and some other stuff. All right, so moving on to a quick example of this. So John was, let's see, Jane's husband. Quick example, illustration. So John here passed away at age 64. He's got 2150. You don't have to get wrapped up in the numbers. What this is going to illustrate to you is why you really want to talk to somebody. All right. Because there's 3 ways you could do this if you are widowed. All right. There's 3 ways you can do it. You can take your benefit, you can take your spouse's benefit, or you can take the widow benefits and delay your benefit till later on. So that's why we put this illustration in here, because we want to show you that there is a correct way to do this. All right. So Jane was 5 years younger. She remained unmarried at age 60. Again, that's a hard and fast rule. And her benefit on her own was $1,197. All right. So not a lot. John's benefit obviously is a much higher at $2,150. Again, there are 3 strategies for this. One is that she files for widow benefits at age 60. Now, okay, there's a couple things that are important here. One is that she's able to file at age 60. She doesn't have to wait to age 62. All right, so that's a benefit. In total, you get $461,000. Her average life expectancy is going to be 85. So that's how much you're going to get out of Social Security, $461,000. Strategy 2 says, hey, you know what? Why don't we file for retirement benefit at age 62, her own benefit, and we're going to switch to the widow benefit at age 67, which is $2,150. So if you add those 2 up, it's $538,000, which is about another $70,000-ish. $70,000, all right, included. Or we say, you know what, there is a third strategy. So you can go ahead and file at age 60. Again, you file at 60 here, but your benefit's lower. File at 62 here, your total benefit is much higher. But you could also file at age 60, the widow benefits. I'm sorry, the widow benefits. And then at age 70, file for your own, benefit. And then you'll see it's $563,000. So by doing this one, it's a 17% increase. And by doing this one, it's a 22% increase. Remember, if you're on this workshop, you're looking for ways to increase your Social Security. This is a big way that we could help folks looking to maximize their benefit. All right, so can you still work? This is probably the number 1 question we get in frequently asked questions. Yes, you can work. You can work, all right? But if we are advising retirees or folks that are about to retire, let me ask you, and you can answer this question in your own head. Are you going to want to work after you start Social Security and have not reached your full retirement age? Remember, for everybody, or I should say everybody, for most people on here, it's age 67. My question to you is, between now and age 67, do you plan on working? If the answer is no, then it's not so bad if you take Social Security early. There's still some drawbacks to it, which I'll explain, but it's not as bad. If your answer is yes, you're going to work and you are going to earn over $23,000, then you have to say, okay, how much are you going to earn over this amount? If you were going to earn 20, or say you're going to earn $40,000 or more over this, they are going to take back $1 for every $2 you go over. So let's say you earned $43,000. Okay, $43,000 you're going to work. You heard that you should start your benefit early because you're worried about them running out of money, or people die early and they don't get the Social Security. There's a couple of different things that you'll hear your neighbors put a little buzz in your ear. But again, let's take it back to the numbers. Your $23,000 limitation as of 2025. If you make $43,000, they are going to take back $20,000 divided by 2, which is $10,000. So they are going to reduce your benefit by $10,000. How does that work? Well, what happens is if you were expecting to get a check in January, February, March, April, you get nothing. The Social Security Administration just does not pay you. They do not give you a prorated amount. They just simply do not pay you your benefit. All right. So just, I had a teacher, she had heard from her neighbor. She had asked me, she goes, well, you know, I started my Social Security at age 62 because I thought they're not going to be able to pay it, or Social Security is running out of money. I said, what would you do that? I mean, she's earning, you know, $65,000. I said, you may get it up until the fact that Social Security figures out that you're making more money than you're allowed, and they're going to claw it all back. You've done two things to yourself. One is that you've eliminated any increases you would have otherwise received. And two, you've locked in your benefit for no reason at all because they're going to claw it all back year 2 on until you turn 67. It's like, well, no, I'm still getting my check. I don't think that's right. I'm like, it is right, I can assure you. But she called me. And obviously her check stopped. She goes, well, I should have listened to you. Please talk to somebody before you make this. This is a crucial decision on the rest of your life. Please be educated. You're on this call, which is great, but make sure that nobody's putting little buzz things in your head that aren't necessarily true. All right. So let's flip over a little bit and talk about how Social Security gets taxed, because it gets taxed in a very, very unconventional way. And it is called provisional income. This document here comes out every year, and it's how to prepare your tax return. This is 2023, but it is 33 pages long, and it just tells you how to pay your taxes on Social Security and what you have to do in order to pay it. So it is a little bit complicated, but let's go dive into it a little bit. Provisional income is the buzzword that Social Security uses to determine how much of your Social Security gets taxed. All right. Your Social Security is going to get taxed by one of 3 ways. It's either going to be taxed 15%, 50%, or 85% of it's going to be taxed. No matter how much money you make, you can be Bill Gates. 15%, by the way, they're working on this and trying to make changes. So I'm giving you today's number. It could change as soon as Trump gets in the office and have nobody pay taxes on it. So I don't know what this is going to result in, but this is how it works today. It's provisional income. I'm going to go over the rest of this really quick because if they make changes to it, you're not going to have to worry about it. And it's going to be done this year if they make changes. So provisional income, this is how it was done and is done as of today. All right. So you take your Social Security, which in this illustration is $24,000. You take half of that. So $12,000 is part of your provisional income. Let's say that you earned $30,000 working a job. So your provisional income, again, this is the only term that is used to figure out your Social Security. It does not affect anything else. Your provisional income is $42,000. All right, so remember that. $42,000. So if you're single and you earned $42,000 in provisional income, 85% of your Social Security is taxed. Super easy, easy little graph. There's 25 numbers. If it is below 25 now, it is not taxed. So this is one of the things that we try to help clients. And we try to help them make sure that they stay under a certain tax threshold. Because if you are single and you have under $25,000 in provisional income, your Social Security does not get taxed. $42,000 here for a married couple, you see, falls in between here. 50% of it. So it's 0 up to 32,000. It is 50% tax, 50% of it is taxed between 32 and 42. And above 42, 85% is added onto your taxes. And it doesn't talk about your tax bracket. That's totally separate. This is just the amount that you pay on your taxes. All right. So provisional income, again, $42,000. I want to show you this because it's important. This is one of the loopholes that you can get out of provisional income. All right. First thing is that some money that you earn does not count towards provisional income. You say, okay, well, that's pretty good. Roth distributions. If you've ever heard anybody talk about doing Roth conversions, this is why. Roth distributions do not count as provisional income. You could take $1 million a year out of a Roth account. You will not affect the amount that you pay on your taxes on your Social Security. All right. You can take as much out as you want. The second type of income that does not count is cash value life insurance. If you've accumulated in cash value life insurance, because it is loans. You're taking a loan out. It does not count as income because you're taking a loan. Again, IRS could change all these guidelines at any point in time, but this is what's available today. And one that does not count, and that's municipal bonds. For those of you who are in high tax states, California, New York, Illinois, you know the states if you're in one. You buy municipal bonds because you don't pay income tax on municipal bonds. However, it does count against you as provisional income. Don't ask me why, but they assume that if you are buying municipal bonds, you probably have a lot of money, and they do not exclude that from this calculation. All right. So again, all this is in flux here. It's been in place now for many years. It could change this year and could change very quickly. Right. So early versus wait. Let's talk a little illustration here. You've got a couple 164, 162. They have $34,000 in Social Security income if they started early at age 62. All right, so this is the important part. You got a married couple, and if they start at age 62, they have $34,000 in Social Security income. Now, they have saved, all right? They've been pretty good about saving. They've got $752,000 that they've saved in 401k and IRA. Keep in mind, though, that they have not paid taxes on the 752, but they have saved it. They need, or we're going to assume that in their investments, they're going to get a 6% annual return, and inflation is going to average 3% while they're retired. They need $70,000 a year to live on. All right. So what this is going to illustrate to you is what's the difference if you're married and you say, I'm going to file early, you and your spouse, versus what would it look like if I filed later? You say, will that really make a difference in my retirement? Okay, that's what this chart, which is on the next slide, is going to illustrate for you. All right, and of course, we need to have life expectancy in here. Life expectancies in here. One's going to live to age 86, the other to age 89. So what is this? This looks like a pretty busy chart, but let me explain. First off, the red line is how much money you need to live. Pretty simple. Most financial planning software is going to give you something to this extent. Hopefully you have something like this or have sat down with an advisor. Orange line is the money that you have in your IRA or 401k that you're taking out of your retirement funds to get you to the money you need, which is the red line. Now, the money above the red line is taxes. So you can't just meet your income need without having to pay taxes. And the blue line is Social Security. Pretty easy. You say, okay, well, this looks great. You know, we got about 23 years here, but you notice something happens. You don't see any more yellow or orange lines here. What has happened? All right. Essentially, you've ran out of money. Year 23, you have run out of your investments. Now we say, oh, that's not good. We definitely do not want that to happen. Right? It's one thing if you want to go live with your kids when you're retired and older. It is another thing entirely if you have to, because you've had to sell all your assets and you no longer have money to support yourself. All right. So let's say, let's change one variable in this equation. And that is, let's say instead of retiring or getting our Social Security early, let's look at what it would look like if we waited. The only variable we've changed, everything else is the same, all right? Red line, the same, $70,000 when you first retire, it goes up 3% cost of living increase. Anything above is taxes. Anything below is money that we're taking out of 401ks. Now, because somebody has decided to wait, you still need $70,000 a year, adjusted for inflation, to live. Where's that money come from? That comes from your savings. What we're looking at here is somebody that said, I'm going to wait to take Social Security later until I hit age 70, but I'm having to use up or use down my 401k quicker because I'm having to make money here. So what does this look like? Well, as you can see, you go 33 years into retirement, 34 years into retirement, before you run out of investable assets. All right. So this is what it looks like. You say, well, geez, what's the difference between the two? Obviously, you were able to live longer and have money in retirement, but what does it equal? What are some of the numbers? Again, this is an illustration, oversimplified on purpose, but we want to make sure that we show you this. So $186,000 more of Social Security, which is a 30% increase. Remember at the beginning of this workshop, I said, we can show you numerically, and hopefully if you come see us, we're going to do this for you, how you can increase your Social Security. Okay, so 30% more in Social Security. 14 more years that they're able to take money out of their 401k. Even though they've taken more out at the beginning of their retirement, they still have 14 more years of investable income that they were able to draw out of during retirement. And trifecta here, and the bonus here is that they were able to save roughly $35,000 in taxes, even with 14 more years of income coming out of their portfolio. All right. This does not get into anything else. Remember, the only variable that we changed here was changing, instead of taking it at age 62, we just said, hey, let's go ahead and, take it at age 70. Now, we did have to fill in the gaps with more income coming out of their portfolio, but by and large, you can see here, we can show you this if you decide to come see us. A couple of things about your statement. Wait a minute, it's 50 after the hour. All of you who signed up for this workshop gave us your cell phone number. And as of right now, you are in the process of getting a link texted to your cell phone that allows you to set up a time to come see us if you want. It's not mandatory. But more importantly, you fill out the information on the link, because it's going to take you to the website to download your workbook. All right. You get that workbook for free. No holds barred. You get that for free. Sit down on your own. You can fill that out. Again, if you want to, there's a little box at the bottom. It says that you want a time, or pick a time to talk to us, and we'll do the heavy lifting for you. And that is available to everybody who is on this call. or who is rewatching it with the replay. All right. So again, about your statement, no cost of living increases have been applied. So it's actually showing you a little bit less than what you would be getting. If you are 60 years old and you're saying, geez, I'm going to get $2,000 a month at my full retirement age, they do not include 7 years worth of cost of living increases, which are roughly 2.5%. So this is one of the things that our software does, is it will kind of give you a more accurate data point for how much you're going to get in Social Security. It also assumes you're going to work to age 62, full retirement age, or age 70. What does this mean? If you're looking at it again and you're 60 years old, it's going to say you are going to work to age 62, and it's going to assume that you're going to make the same amount as you did last year. So for those of you who are looking to retire at age 60, but take your benefit later on, your benefit is again going to be under the benefit, because it's going to calculate you working. If you're looking at it and the number you see at age 62, it assumes you're going to work to age 62. If you're looking at your full retirement age, which is 67, it's going to assume you're working till then, or age 70, it's going to assume you're going to be working till then. So it does underrepresent the amounts when you look at it that way. And it's your record only. Remember, probably 50% of the folks that come see us are married. So it's not going to look at a spousal benefit or help coordinate it. Remember, we went into that a little bit. If you're looking at, husband, wife, what is the best way to get the highest benefit? And you really need software to pull that apart. But more importantly, the statement you get doesn't show you that. It's not going to be able to figure it out, because they only give you your record. Remember, Social Security Administration is very tight on the information. They will give you your information. They will not give you somebody else's. Nor, if you call them, will they give you advice. They are not. They essentially do not want to give you advice, because if they give you the wrong advice, who's going to be responsible? You or them? They're going to say they didn't give your advice, and it's all going to fall on your shoulders if you make the wrong decision. All right. Again, we already went over that. So I like to also follow this up with a Roth rollout strategy. It's kind of an addendum to this workshop. Here's a quick illustration for a married couple. Both were government workers. They happen to be clients of mine that I had talked to. They did not need investment income, meaning that their pensions and Social Security were going to cover their living expenses. They retired with about $1.3 million in IRAs and tax sheltered, meaning that they retired with $1.3 million, but they had not paid taxes on it. Right? It could be, in their case, it was 403Bs and 457s, but for you, it could be 401k and IRAs. So they have about $1.3 million that they didn't really need. And I love this because it, again, this is hypothetical, illustrated, but it was with their numbers. You can see here that this is the amount that they are paying in taxes, right? This isn't the amount, this isn't their income. This is the amount that they're paying in taxes. And you scratch your head and you're like, geez, why in the world would they have to pay $300,000 in taxes or more? It's because their accounts are going to grow. And in this case, they're going to grow at, 6 to 10%, depending on how your asset allocation is set up. And they weren't needing it, so it was going to grow quite a bit. But what happens is that they're forced to take distributions. It's called a required minimum distribution. Based on your age, it could be 73, 74, when you're forced to do this. However, you're forced to do it every year. And the IRS doesn't care if you have to bounce up tax brackets and hit the 37, 34, 32% tax brackets. They don't care. They say, well, you've accumulated quite a bit of money. We are forcing you to take the money out. And by the way, we want our pound of flesh. That's essentially how it works. And down here at the very beginning, when that couple retired, it's not too bad. Not too bad. However, once you start getting later in life, the RMDs kick in, they never go down. They start off at roughly 4% and they go up a little bit every year. And you can see here, according to the calculation, they would pay $500,000 or more every year later in life. $500,000 out of a $1.3 million account. They are having to pay $500,000 a year in taxes. All right. So you say, well, you're kind of beating this to death. What is the strategy? The strategy here is to do Roth conversions. So if you have not looked at this and you have anything over, $500,000 or more in non-taxed accounts, we will help you put this kind of illustration together for you and show you whether or not it is a benefit. Here's where it comes into kind of the delineation. One is that this couple, they didn't need the money to live on. And I've done this, and if you are taking money out, quite a bit of money out, because that's all the money you have, you don't have pensions, you're, say Social Security, you're a business owner, Social Security was low because you never really paid a lot in the taxes. This may not work for you, but if you have $500,000 or more, we will run this for you to figure out if it is of your in your best interest to do this. So this right here just shows you, okay, if we did do a Roth conversion, what would it look like? All right, the red line here is paying more in taxes than you otherwise would if we do a Roth conversion. And a Roth conversion is simply taking money out of a tax deferred account, 457, think 457, 401k, 403b, tax shelter annuities, you name it, 451s, and putting it into a Roth account. Now, two things. One is that you can do unlimited amounts into Roth conversions, even though I get this question a lot. People think that they can only do $8,000 a year into a Roth conversion. That's not the case. You can do unlimited in the Roth conversions unless they change tax code. So we would do Roth conversions. So you're paying more at the beginning. You say, well, if I pay the taxes up front, does it help me? And the green line is all the reduction in taxes going forward, right? So really you're paying up front the taxes and you are saving on the green line. You say, okay, good. That's a good illustration. What did it help you, right? The end result is that this looks good if you see this, but we want to know if it is going to help you. So for that couple, again, the illustration, it would save them roughly $1 million in taxes by doing Roth conversions and paying the taxes early, then paying it later on. And the reason being, okay, you understand the reasoning is that because of RMDs, or because the government is forcing you to take money out, you're also being forced up in the tax brackets. All things being held equal, if the United States was on a flat tax system, it would not matter one bit if you paid the taxes today or you waited 30 years to pay the taxes if it was a flat tax. That's not the case. We have a progressive system. As long as this progressive system is enacted or we're paying using this, as you can see, it helps you quite a bit. So it helps you save $1 million a year. So they're like, okay, that $1 million a year, or I'm sorry, $1 million in lifetime tax savings. So here's some of the results. Again, they save you about $1 million in taxes. It increases tax-free net worth about $2 million, which allowed them through inheritance and charity giving to say if they never needed the money for anything, it would give them roughly $4 million extra at the end of their lifetime that is completely tax-free. So they had children, they were going to leave the money to their kids, but they would have paid the taxes for their kids, and your kids would get this tax-free. Again, I'm going a little bit on a tangent, talking about some of the things you could do. Maybe for you, if you're single, you would want to give it to charity. Maybe it all goes wherever you decided to go. But that is one of the ways that you could give more and also alleviate the burden from your kids on having to pay a bunch of taxes with it. Okay, So now again, you have two choices. You are going to be able to download, because you've already received the link texted to you. And I'll also show you, if you did not get it text, you're watching this after the live broadcast, how you can go and get this as well. But you have two choices. One is that you can download the workbook and do a lot of this on your own. You don't get a lot of the advanced reports, but that you certainly you are entitled to that. And the second option, again, is for us to schedule time to talk to our team. We're going to give you turnkey reports. And in the event you did have Roth conversion questions, or you do have money that is in IRAs over, $500,000 or more, we'll run that report for you so you can see if it's worth it for you to do or not, and save your family some money on taxes. And out of the hundreds of reports that we've run for folks, my team and I, nobody said they didn't get any value out of this. That you get a lot of value out of it, because what it does is it gives you peace of mind. Peace of mind in your retirement on the most difficult decision as to when to start Social Security. You're going to know exactly why, and you're also going to know exactly why you did it. All right. So again, these are some of the reports that we give you if you have us do it for you. It talks about your estimated income, Social Security. It also gives you kind of your break even. One of the questions we always get is, if I started early versus wait, where's my break even? And in this example illustration, again, it's going to be about 77, 78 years old. Now we do run into folks. I was working with one gentleman who had a lot of health issues. All right. He was working. He had a quadruple bypass. He had diabetes. He was on dialysis. Did we say, hey, why don't you wait until age 70 to start your Social Security? No, obviously we did not. We went ahead and started his Social Security at age 62. Thankfully, he's still with us, but his average life expectancy is not in the late 70s, early 80s. So for him, it made more sense for him to do that. And everybody's different. But again, just it's not blanket, everybody wait to age 70. That's not necessarily the case. So what you get if you come see us, you get your Social Security analysis, you get the workbook, you get the Roth rollout strategy. And you can also schedule a time to meet with us. Let's see, what time is it? It's 8 o'clock. So actually tonight I ran a little bit long. So I'll take a couple of questions here. And if you are watching this after the time, all you have to do is go to www.maxoursocialsecurity.com. maxoursocialsecurity.com. That's where you can set up a time to see with us, but it's also where you're going to get the free workbook. Right. So if you want the workbook, you fill this form out and hit submit. You just the question here is if you want your free Social Security analysis. If you don't want it, click no, hit submit, and it automatically sends you the workbook. All right, so let's jump into just a couple of questions. I know I'm running a little bit over. I really like to end this right at 1 hour. But let's go ahead and jump over. All right, so let me go ahead and see if there's any questions on the websites here. All right, so majority of folks are on Zoom. Let me open up the Q&A. If you're on Zoom and you want to ask us a question, feel free to just click the Q&A, and that will pop up instead of the chat. The chat is for everybody to see. If you want questions in the Q&A, you can go ahead and ask that. All right, first question. I'm married, but my spouse never worked. Okay, so you're looking at doing spousal business owner. So this, I love business owners. Typically, let's say they don't pay the most in taxes because they're not W-2 earners. Unfortunately, you can't increase. And it looks like if your wife was working from home, or not really working, but did not pay in the Social Security very much, then she would be able to get half of your benefit. If you are, if you're self-employed, then yeah, you haven't paid much into Social Security. She would be entitled to half of your benefit. Unfortunately, it seems like your benefit is kind of small at about $1,200 a month. So yeah, she's entitled to $600. But remember, the way it works is you have to file for your benefit first. So in the event you wanted to increase your benefit by either paying yourself more, assuming you can do that, then it may not be worth it. You really have to pull it apart, or we'd have to put it in and sort of guess as if you were to pay yourself more. But remember, as self-employed, and again, this doesn't pertain to everybody, but if you're self-employed, you not only have to pay the 6.2% for Social Security on your salary, but you have to pay 6.2% um, all on your own because you are the employer and you are also the employee, right? So you're paying the 13 or 12.5%, 12.4%. But in addition to that, you're also paying yourself Medicare. Uh, um, you're also getting taxed on Medicare. So there's a double whammy if you're self-employed. Does it benefit you? It depends on how much and how long you've paid into. Um, and anyhow, if you want to talk to us, we'd be more than happy to help you walk you through that. You're kind of a sticky situation. We really need to talk to you one-on-one for that, only because you're self-employed. And we work with a lot of self-employed folks, but is it worth it for you to start upping your salary? Depends on really how many more years you plan on working and paying yourself a salary. It may benefit you a lot, or it may benefit you not at all. So, anyhow, we'll take a look at that. All right, so I'm really running long on I'm almost hour and 10 minutes. So I do appreciate everybody being on here. Again, this is recorded. You will get a link to the recording, which will be on YouTube. So if you missed something or have questions, feel free to share this again with somebody you know if they are having questions. And again, if you're watching this and it's part of the rebroadcast, you go to maxoursocialsecurity.com. This is where you're going to download your workbook. And if you want to set up a time with us, you just click yes, and then pick a time on our calendar that you want to talk. Very, very straightforward, very, very easy. We do appreciate you being on the call. Again, because you've signed up for this workshop, we do have other workshops, retirement workshops, how to get the most out of retirement, how to get lifetime income. We have a couple of ones. You will see occasionally an invitation to those as well. Feel free to do that. We will have an estate planning workshop here very soon. So that will help a lot of people as well. But again, we're going to go through a whole thing this year and help people who want to help themselves. Just join one of our workshops, and thank you. So thanks again for being online and being on this workshop, and we look forward to seeing you soon.